It's 3:47 a.m. in a data center outside Dallas. A facilities manager is staring at a power meter that's redlined for the third time this week. The AI servers are hungry and getting hungrier. Everyone's chasing Nvidia, the ticker symbol that turned a graphics card company into a $2 trillion AI juggernaut. But here's what most investors are missing. The rally you're seeing in the Dow? There's more to that story. In just buying chips, it's buying everything those chips need to run, and that's a $3 trillion story. Morgan Stanley just put a number on it, nearly $3 trillion flowing into AI infrastructure by 2028. And here's the part that should get your attention. More than 80% of that spending? It hasn't happened yet. The build-out is just getting started. Today, we're going beyond the obvious names. We're mapping the entire AI infrastructure value chain, from memory chips to power systems to fiber networks. The picks and shovels play. Let's start with a number that should reframe how you think about this opportunity. More than $700 billion will be spent on AI infrastructure in 2026 alone. To put that in perspective, that's more than the GDP of all but 24 countries, flowing through this sector in a single year. But when most people hear AI investing, they think Nvidia, maybe AMD, perhaps a handful of cloud providers. That's the tip of the iceberg. Think about what an AI data center actually needs. GPUs are just the start. You need high-bandwidth memory running at speeds that would have seemed impossible 5 years ago. You need advanced circuit boards that can handle power loads your laptop couldn't dream of. Power systems, cooling infrastructure, miles and miles of fiber. The old gold rush analogy, it's not Nvidia. Nvidia is the gold. The real picks and shovels money is in everything that makes the gold usable. Now let's talk about why the timing matters. In January, Nvidia unveiled something called the Rubin platform. 6 chips, 1 AI supercomputer, a complete redesign from the ground up. The flagship R100 GPU contains 336 billion transistors. That's more than 15 times what's in the chip powering your smartphone. But here's the number that matters for infrastructure investors. Rubin delivers 5 times the inference performance of Blackwell, the previous generation, at 10 times lower cost per token. That efficiency gain changes the math for every company deploying AI. Suddenly, what cost $1 million to run costs $100,000. At that price point, AI goes everywhere. And here's where infrastructure demand explodes. Rubin systems need just 72 GPUs to match what took 288 DPUs in the previous generation. Fewer chips, but massively more demanding on everything else. The Rubin platform uses HBM4 memory delivering 22 terabytes per second of bandwidth. That's 2.8 times what Blackwell could handle. The memory suppliers can barely keep up. This is where the opportunity gets interesting. Because Nvidia makes GPUs, they don't make HBM memory, they don't make the advanced packaging, they don't generate the power. The smart money is already moving. According to Motley Fool analysis, the real picks and shovels play is in the plumbing circuit boards, power systems, fiber networks. Let's break down the value chain. Start with memory. Every Rubin system needs HBM4 that's high bandwidth memory stacked in 3D towers on the same package as the GPU. Micron, SK Hynix, Samsung, they're racing to supply this memory, and the demand is outstripping their capacity to manufacture. Then there's power. A single AI data center can consume as much electricity as a small city. The companies building power infrastructure for these facilities are seeing orders surge. Companies you've probably never heard of. Bel Fuse makes power conversion equipment. TTM Technologies builds the advanced circuit boards these systems run on. Both are seeing real growth from AI demand. Cooling is another piece most investors miss. These chips generate tremendous heat. The cooling systems required are specialized, expensive, and in short supply. Liquid cooling, immersion cooling. Some facilities are literally submerging servers in specialized fluids. It sounds extreme because it is. And then there's fiber. AI systems generate and consume massive amounts of data. That data has to move. The companies laying fiber and building networking equipment, they're essential. Now, here's what makes this moment particularly interesting. After the AI sell-off in early 2026, many of these infrastructure names are trading at significant discounts. The anything but AI crowd got loud in Q1. Money rotated out. But here's the thing. The fundamentals didn't change. If anything, they strengthened. According to Fidelity Research, AI adoption is now shifting from experimentation to production scale, fewer pilots, more tangible productivity solutions generating real revenue. That shift matters enormously for infrastructure. Experiments need a few servers. Production deployments need data centers. The scale difference is orders of magnitude. Rubin systems start shipping to major cloud providers in the second half of 2026. AWS, Microsoft, Google, Oracle, they're all in line. When that happens, every company in the supply chain sees demand accelerate. Memory makers, power equipment manufacturers, cooling system providers, network builders. So what does this mean for your portfolio? First, and I want to be careful here because your situation is specific to you, consider looking beyond the obvious names. Memory suppliers like Micron have exposure to the HBM4 build-out. Power infrastructure companies and advanced PCB manufacturers are seeing real demand growth from AI facilities. The early 2026 sell-off may present opportunities in well-capitalized companies trading below where fundamentals suggest they should be. Past performance doesn't predict future results, but valuations matter. You might want to think about the Rubin transition specifically. Companies positioned for next-gen AI systems, HBM4 memory, advanced packaging, historically tend to outperform those tied to current-gen tech during platform shifts. If you want diversified exposure without picking individual names, there are sector ETFs focused on semiconductors and infrastructure that give you the theme without single-stock concentration risk. Now, I want to be honest about the risks. The core debate in this sector is whether AI infrastructure spending is sustainable or whether we're building for demand that won't materialize. Bears worry about overcapacity. Hyperscalers are spending aggressively on infrastructure that may take years to generate proportionate returns. That's a legitimate concern. And there's technology risk. Rubin obsoletes Blackwell in meaningful ways. What obsoletes Rubin? The pace of innovation could strand capital in equipment that's outdated before it's paid off. The picks and shovels strategy reduces single-company risk. You're not betting everything on one chipmaker, but it doesn't eliminate sector risk if the entire AI thesis disappoints. What you might consider is watching the shift from experimentation to production. Companies showing actual AI-driven revenue growth, not just pilot programs, are the ones that tend to deserve premium valuations. Monitor what the institutions are buying. When the pension funds and endowments start building positions in these infrastructure names, that's signal worth paying attention to. Remember, Morgan Stanley's $3 trillion figure assumes continued adoption acceleration. If that happens, the infrastructure build-out has years to run. If it doesn't, the math changes. The data coming out of enterprise AI deployments so far is encouraging. Real productivity gains, real cost savings. That's what separates this cycle from previous tech hype waves. If you found this breakdown useful, consider subscribing. We cover stories like this every week where the money is actually flowing, not just where the headlines say it is. Your homework, if you choose to do it, is simple. Pick one company from each part of the AI infrastructure value chain: memory, power, cooling, networking. Learn their story. Understand what they make, who their customers are, how Rubin adoption affects their demand. That kind of fundamental research tends to pay off when everyone else is chasing headlines. Because here's the truth about infrastructure investing. It's not exciting. Nobody's making viral posts about circuit board manufacturers. But that's exactly why the opportunity exists. $3 trillion. That's not a projection pulled from thin air. That's Morgan Stanley tallying up what cloud providers, enterprises, and governments are actually committing to spend. The question isn't whether AI infrastructure investment is happening. It's already happening. The question is whether you're positioned for where the spending actually goes, beyond the obvious names, into the infrastructure that makes it all work. This is Money Moves Daily. The smart money isn't just buying chips. It's buying everything those chips need to run. That's the picks and shovels play. That's the infrastructure gold rush. Remember, this is educational content, not financial advice. Your situation is unique. Talk to a qualified advisor before making any investment decisions. We'll see you next time.